Hello and welcome back to the channel, and nice to see you all. Nothing wrong with technical analysis, but why traders lose money? Using technical analysis is the key of trader success, but why some traders lose money? In this video, I am going to talk about 4 important rules that you have to consider before you enter the trade and avoid losing money as much as you can. And the first one is never consider support and resistance as a line. Always consider it as an area. Support and resistance is a part of price action technical analysis. And if you consider your support and resistance as a line, it may confuse you more than ever. That's why you lose money and trade, which most of the time can be avoided. Here I'm going to show you what is the proper way to draw your support and resistance and why you lose money and how you set your stop loss and profit target. In trading market, no one knows where the price might go next because all our assumptions are based on probability and statistic. But if you draw your support and resistance the proper way, you are going to be one step closer to profit.
In this demo graph, let's assume the price move up in your direction and hit a valid resistance line and then bounce back and hit the support line. The price once again bounce up and try to retest the resistance and break up the resistance and close above the resistance with a bullish candle. Some traders, they enter the trade at the close price of this bullish candle and put their stop loss below the support previous resistance. The price retest the support and heading upward. Some other traders, they enter the trade at the close price of this bullish candle and put their stop loss below the support. Soon after, the price reverse its direction and going downward, hit the stop loss and kick traders out of the trade. The price continue going down, bouncing between support and resistance, and finally break down the support and close below the support with a bearish candle. Some traders, they exit the trade at the close price of this bearish candle and put their stop loss above the resistant previous support. The price retest the resistant line and heading downward. Some other traders, they exit the trade at the close price of this bearish candle and put their stop loss above the resistant line. After the price consolidate and finally break the resistance, break out the resistance and going upward, hitting their stop loss and put traders out of the trade. Here again, traders lose money in both situations due to one simple mistake. Let me show you how. Never consider support and resistance as a line. Always consider them as an area. That's why you lose money. Look at the chart one more time. I replace the support and resistance line with an area. As you see in the first and second situation, the price never break out neither the support nor the resistance. It only fluctuates within the area, and you should wait for the price to exit the area and then set up your entry. Let me show you a real example. In this graph, British Pound Canadian pair H1 time frame, I installed first my resistance line. The price move here going upward, hitting the resistance, and it get rejected by the resistance and going downward, close below the resistance with the bearish candle, so I can exit the trade at the close price of this bearish candle and put my stop loss above the resistance line. In the second scenario, the price move up and break up the resistance and going up and close above the resistance with a bullish candle. So I can enter the trade at the close price of this bullish candle and put my stop loss below this line or below the support previous resistance. Now I replace my resistance line with an area. In the first scenario is still the same. The price go up and it get rejected by the resistance and close below the resistance. So I can exit the trade at the close price of this bearish candle. In the second scenario, the price didn't break out of the resistance. It went inside the resistance, fluctuate inside, and then it reverses and close below the resistance area. It trigger my previous stop loss and put traders out of the trade because they consider the resistance as a line, not as an area. Now, to enter the trade, to exit the trade here, I put my stop loss 180R above the close price of this bearish candle for a stop loss and 280R below the close price of this bearish candle for profit target. Here I can get 2-to-1 reward risk ratio. So this is my stop loss and this is my profit target. So here we see in the second cases we lose money due to one simple mistake, that we consider the resistance as a line, but we should always consider this resistance as an area. This is the same graph as you see before, British pound Canadian pair H1 time frame, and this is my trend line, and these are the two locations, number 1 and number 2, that I'm going to consider. In my first location, the price move upward, hit the trend line and got rejected and reversed down. I also have a bearish engulfing showing a possible trend reversal. So I can exit the trade at the close price of this bearish candle and put my stop loss above a distance above the resistance. And the second location, and in the second location, the price come down and hit my support and penetrate inside the support and close below the support. So some traders, they can exit the trade at the close price of this bearish candle and put their stop loss 180R above the trend line. Then I'm going to replace this trend line with the trend area. Now, the first location, it is still basically the same. The price move up and hit the resistance, penetrate inside, and then reverse back and close below with a bearish candle. So I can wait for the next candle to form and coming down below the close price of the first bearish candle. Then I can enter the trade and put my stop loss a distance above resistance area. In the second location, the price coming down and hit the support area and fluctuate within the support area and then exit the support with a bullish hammer, as you see here, and close above the support. Trigger my stop loss and put traders out of the trade. So I can enter the trade at the close price of this hammer, to ATR below the close price for stop loss, and 4 ATR above the close price for profit target. And these are the information for this hammer, and this is the ATR value for this hammer, and this is my stop loss, and this is my profit target. So here we see in the second cases that we lose trade and money due to one simple mistake: never consider trend line as a line, always consider as area if you do not want to lose money. Number 3, breakout is not always predictable. Be prepared. Don't count on trending market to continue in your direction. It may reverse any time. When market is trending upward or downward, there is no guarantee the trend continue in that direction. Anything could happen. It may surprise you by sudden breakdown lower or break up higher, trigger your stop loss and put you in court. Therefore, you have to be prepared to cut your losses short and then move on. That is the truth, and that's why you lose money. Look at this price trend FRU stock D1 time frame Yahoo Finance. The price is making higher swing high and the pullback is making higher swing low all the way up for almost 4 months, going up in upward direction, and traders think the trend will continue going higher in their favor, and they think to enter the trade and buy the breakout right here. The market quickly reverse against and collapse lower, as you see here. This happened at the moment that you were confident that the trend will go in your favor. This is the reality, and anything could happen in the market, no matter how professional you are, how great the chart look like, and how nice your trading setup is. This is the fact behind any type of breakout, pullback, and reversal trading. My only suggestion is be prepared and cut your losses short and move on if you want to be a successful trader. Let me give you another example. Look at this price trend, Euro USD pair, H1 time frame. The price is trending nicely upward all the way up for more than 3 months. The trend line shows the price is nicely going upward. Traders think the trend will continue going higher in their favor, and they think to enter the trade and buy the breakout right here at this bullish candle. The market quickly reverse and collapse lower, as you see, trigger their stop loss and kick them out of the trade. This was happened at the moment that they were confident that the trend will continue going higher in their favor. This is the reality of trading market, and nothing you can do about it, no matter how professional you are, how great the chart look like, and how nice your trading setup is. My only suggestion and advice is to be prepared, cut your losses short immediately, and move on if you want to be a professional trader in future. Number 4, don't put your stop loss just below support or just above resistance if you do not want to lose money. When you enter the trade and put your stop loss just below support or just above resistance, never think the trend will always move in your direction. Be aware that you may lose your trade and money at the same time because there is not enough room for the trend to breathe. Have you ever seen a situation that the price coming down to support and then bounce back heading upward due to a strong bullish engulfing or hammer formation at the support area, and you decide to enter the trade and put your stop loss just below support waiting for the trend to go up in your direction? Soon after the price retests that support level and go down below support, trigger your stop loss and put you out of the trade, and then it reverses in your direction going strongly upward. This situation could be avoided by putting your stop loss a distance below support, and you will still be in the market and make money instead of being out of the trade and lose money. Let's look at this price trend, USD Canadian pair and 4-hour time frame Yahoo Finance. The price is trending strongly upward for more than 1 year. And as you see, the pullback is coming toward support area and it got rejected by this strong hammer at the support area. And you were confident that the trend will continue in your direction if you enter the trade at the close price of this hammer. So you decided to enter the trade at the close price of this hammer and put your stop loss just below the support. Just below the support here. The price then retest that support and went down below the support, triggered this stop loss and put you out of the trade. This could be avoided if you put 1 or 2 ATR distance below the close price, maybe 2 ATR below the close price of this hammer for a stop loss, and 4 ATR above the close price for profit target, above the close price of this hammer for profit target. This way you get 2-to-1 reward risk ratio, and therefore you are going to have this is for stop loss and this is for profit target. So you see your stop loss value is 1.2934, and the lowest price in this pullback, which is this bearish hammer, is 1.2950. Then you are well protected and the market never trigger your stop loss, and you were in the trade and enjoy making money, and to see the trend is going upward all the way up and the trend going in your direction. Average true range, it shows the average volatility of the market, and when you use 1 or 2 ATR, your stop loss has a room to breathe and your entries will be well protected from being triggered. So the point I want to get in this slide is never put your stop loss just below support or just above resistance if you do not want to lose money.
That's all, folks. If you like this video, thumbs up and subscribe. Thanks for watching. Take care and see you next time.